Hello everyone, in this video I will be explaining you how to start investing in Canada. First of all, let us look at why you should consider investing, because some people will be thinking why I should invest, why should I take risk and start investing in other forms wherein which the returns are not necessarily guaranteed, and why I should take that risk. So I will simply explain that to you in a moment. So let us look at why I should invest. Let's go back to 2015, where the minimum wage in British Columbia was $10.45, and you can see that in 2024 it has gone up by 66%, and now it is $17.40. That means the wages are going higher at a lower pace when you compare it to other investment class such as gold. So price of gold in 2015 was around $1,500, and in 2024 the price of gold is around $3,200, which means it gave an average return of 113%. So it is very high compared to the amount of salary increase in terms of minimum wage comparison. So same with S&P 500. It was $200 in 2015, and I'm using an ETF that tracks the S&P 500, which is called as SPY, and the price of one share of that ETF was $200, right? And in 2024 it is around $540, which means it has given a return of around 170%. So what does this mean? So this means that the amount of money that we are receiving as salary is not going up in a pace that is comparable to the price or the investments, right? So the investment people make are giving a better return over a period of time compared to the money that we are receiving in terms of salary. So moving forward, if you plan for another 10 years, if there's the same dynamics keep up, which means that if the same scenario exists even after 10 years, we will be at even more financially difficult situation, right? Because our salaries are not keeping up, but all these investment classes are going higher, right? So when these investment classes go higher and our salaries do not go to that limit, what happens is that people who have invested smartly, they will be able to benefit from that returns, and they will be able to have a better life. So that is the number one reason people should consider investing. How much portion of your salary should you consider for investing? That is a very interesting question, because as per a common financial rule, it is around 20% of your gross income that you need to consider for investment. But you can talk to your financial advisor more to know what are your financial goals and make plans accordingly. So in this particular video, we will be talking about GIC, TFSA, RRSP, and the FSHA. So let us start with the GIC. What is GIC? GIC is something like a fixed deposit. You're investing a particular amount of money, and the bank is giving you a fixed rate of return. So the returns are guaranteed. The bank says, okay, if you give you your money and if you're going to hold it for a certain period of time, it works very much the same like a fixed deposit. Most of us would have used a GIC when we were filing for our visa applications, because GIC is like a fixed deposit and the bank is going to give a guaranteed returns after the lock-in period. Or if I put like $10,000 with the bank, and after end of first year, let us say the bank guaranteed 5%, so 5% return will be guaranteed along with the $10,000 investment that you made in that bank for that particular 1 year period, right? So that is how GIC works, and GIC is very simple, and you can go to any bank and say I want to open a GIC, and they will give you the terms and conditions. They will give you the interest rate. So higher the interest rate, it is better, and the lock-in period also depends upon when you want the money back. And that is a simple explanation of how GIC works. And one of the most common account in Canada is the TFSA account. So TFSA account means it's a tax-free savings account. Just by hearing the name, it's a bit confusing, I would say, because you have to understand that only the returns are tax-free. So which means the contributions are not tax deductible. So you can every year invest a particular amount in your TFSA account, and you can grow that amount. which means let's say this year the contribution limit is around $7,000 and you invest in a particular fund. You can even invest in GIC, but I don't know how to do that. Maybe you can check with your bank and understand that thing. But if you invest let's say $7,000 in a stock, right, a particular stock, and let's say that stock doubled in its value, so the $7,000 investment becomes now $14,000. So the capital gain of $7,000 that you make on this investment is completely tax-free even when you withdraw that amount, right? So that is how the TFSA works, and that is the most important benefit of TFSA, that the returns that you make out of your TFSA account is tax-free. So whenever you are trying to do some investment in your TFSA, understand that the contributions are not tax deductible, but the returns are tax-free. So try to invest in products that can give you really good returns. This point has to be really clear. So that is how you have to maximize your returns without paying any tax. But the risk is also higher because you have to understand the market cycles. You have to buy at a low price and try to sell it at a very high price, right? That is how you can make money. So you have to have a particular plan in your mind. The next type of investment that's available in Canada is RRSP. RRSP, as the name suggests, is the Registered Retirement Savings Account. The contributions are tax deductible and the withdrawals are taxed with a few exceptions. So it's slightly different from TFSA. So in an RRSP, you can reduce your taxable income by contributing into an RRSP. And by doing so, you are not completely removing tax, you are only offsetting the tax for that particular year. So what you're doing is, when you make that contribution to your RRSP, your taxable income limit comes down, right? These contributions act as a tax deductible, so your total income that needs to be taxed for that particular year lower. So that is how you save some money on tax. Again, on your RRSP account, you can start investing in a stock market, and you can buy equities or you can buy bonds, etc. So all the returns will be taxed when you withdraw. So that is the main drawback about RRSP, that you're only offsetting the tax for this particular year. In a future date, when you are withdrawing money from your RRSP account, you will have to pay tax for that. So usually what happens is that people will grow in their career and their salary also grows higher over a period of time, hopefully. So if that happens, and when you want to withdraw money from your RRSP, now your overall tax burden is going to go higher, even higher than in the first place of the first year, where you could have used that money to spend for things that you wanted. But knowing this, there are some withdrawals that is tax exempted. One of the most common is for the first time home buying, where people can use some of the contribution on your RRSP and use it for the purchase of your first home. But again, here there is a catch. There is a limit to which you can withdraw, and even if you withdraw, you have to replenish that amount within a certain period of time. So there are some complex nuances with an RRSP as well. And the third one is a first-time home buyer account. Again, here it is definitely meant for somebody who wants to purchase his first house, and the contributions are tax deductible. And you can also invest in stocks and ETFs and any kind of asset classes that you want to invest, and can generate returns, and you can withdraw this money for buying your first time home buyer. I'm not going into the details of each. All these are available in the Canadian Revenue Agency website. Opening up a TFSA, RRSP, FSHA, I have used Wealthsimple for opening an account for all these platforms, and it was really easy, and I trust that platform for over 3 years now, and it's a very stable platform. I put the link in my description below if you want to check it out. That's all about the various investment opportunities in Canada. Thank you for watching.